Welcome back, everyone. Today is Sunday, December 1st. This is the update on the S&P fair value discussion for our end of November 2024 update. So let's get started. First, a bit of housekeeping. Again, the information here is my opinion only. This is not financial advice. Please consult a finance professional or an advisor for any questions that you've got that are specific to your own situation. And finally, just a bit of an overview on what we hope to get out of this. This is a high-level discussion. We're going to use common S&P 500 ratios and relationships to try to determine the relative attractiveness of investing in the S&P 500 and ultimately the risk-reward balance. This is all quantitative. We're trying our best to be as objective as we can. I certainly understand there's a lot of emotions, a lot of commentary that's available out there, and you can go find that if you want to. But we're going to try to avoid that the best we can in this discussion. And everything we're doing here is utilizing publicly available information. Anyone who's watching this video can go out and replicate this data very easily. And the goal here, of course, is to provide a mid-month and an end-of-month update. The discussion today is the end of November update. So let's get going here. We've got some charts that we'll go over. We're going to start with just the S&P 500, again on a log scale. And not much has changed since last time. There's been a little bit of volatility, but the S&P as of today is sitting just above 6,000. And again, the long-term trend is certainly up. Although this discussion is focused on a bit of timing and relative attractiveness, I'm a big proponent of taking the long view, and certainly over the long term, even with the ups and downs, the S&P 500 is a wonderful investment. Let's look at the yield curve, and there has been some change since the discussion, the mid-month discussion. The long bond, the 30-year bond, has dipped a little bit. I think when we did this discussion last time, the long bond was right around 4.5%. It has dipped down a little bit, maybe 20 to 25 basis points, depending on if you're looking at the 10 or the 30. And that does matter. You'll see as we get into this video, as long bond yields decline, it does bump our fair value estimate up a little bit. But still, overall, with the Federal Reserve dialing down the overnight rates, the yield curve is certainly flatter than it was a year ago. Still a little bit of inversion in the middle of the curve. But again, the long bond has ticked down just a little bit. So digging in a little bit, let's look at some price to earnings history here. And I've got three lines to show you. One is showing the PE on an operating basis. One is showing PE on a reported earnings basis. And the green line is showing the CAPE or the Shiller index. And all three, showing similar trends. The CAPE in particular in green, we talked about this last time. This is pretty high, not the highest it's ever been, but it is approaching 40, and certainly something that I do keep an eye on, as I think this is a valuable index to watch. I tend to favor the reported earnings as opposed to the operating earnings. I feel the reported earnings are a little more grounded in reality. But whatever your flavor, whatever PE flavor you're looking at, you can see that we're not the highest we've ever been, we're not the lowest we've been, but certainly things do look a little bit elevated as we approach 30. Real quickly here, looking at price per dividends, this is effectively saying how much you are paying for a dollar of dividends, and this, again, like a lot of metrics we're going to look at, is pretty high. Not the highest that we've seen as it was in the late 90s, but we've crossed 80 here. And again, if you use dividends as a proxy for value, it would appear that things are a little bit frothy and relatively expensive here. Looking now at a comparison of the PE ratios of the long bond versus the S&P 500, and real quickly, and I'm going to go into a little more detail on this, you can get the PE ratio of the long bond simply by taking the inverse of the yield, right? And so I mentioned at the start of this, the long bond right around 4.3, maybe 4.33%, down about 20 basis points since our last discussion. But still, if you look on this chart with the S&P 500 sitting above 6,000, there has been an inflection here over the past 12 to 18 months where stocks are more expensive relative to long bonds, and that is important. Has not been the case for the past really 10 to 12 years as we've come out of the Great Recession and with COVID, with long bond yields very, very low. Stocks have been relatively attractive. That has changed a little bit today. And again, like I said, stocks appear more expensive than bonds. Why is that important? I added this chart, this slide in from last time. I want to make sure you understand why interest rates matter so much when valuing the S&P 500. And I've broken this down into three sections. You'll see a green section, which is denoted by low interest rates or less than 3%. The yellow section, which I've indicated, is moderate interest rates or 4 to 6%. And then the red area showing higher interest rates of 7%. And this graph is meant to give you an illustration of what is a fair value PE of the S&P 500 at any given interest rate. So if you look down at the x-axis, we have different interest rates ranging from 1% to 15%. And on the y-axis, or the vertical, this is showing a range of fair value price to earnings ratios. The first thing you'll notice on the graph is that it's not linear. And this is important because as interest rates get low, as they get particularly below 3%, the fair value price to earnings ratio goes up exponentially. And this is the reason why during the last several years, especially around COVID, when long bonds got around 1.5% or even 2%, that there is so much support for high stock valuations. You can see that as you get down to 2% on the long bond, as you get down towards 1% on the long bond, the corresponding PE ratio of the S&P 500 is 50, 60, 80 times earnings. And this gives a lot of headway and a lot of tailwind for stocks to do well, and they did do well. Now, as you move on, as you get into a period of what I would call moderate interest rates or transition interest rates, this is where we are today. Again, the long bond, call it 4.5%. You can see how the fair value price to earnings ratio has dropped off dramatically and is now, as you get between 4 and 5%, is between 20 and 30 times earnings. That's a big difference than between 60 or 80 times earnings when the long bond is 2 to 3%. And then again, as rates move up, as rates get above 6% and certainly move towards 10 or even higher, that curve really flattens out, right? You start to see earnings or a corresponding PE ratio of probably 15 to 20 times earnings. And this graph here, just one more note, I think this graph is the reason that so many people anchor on a PE of 15 or 20. A lot of people will just apply a blanket ratio when they're doing stock valuation, and say the S&P is fair value at 15 times earnings. That's not really true. It really depends on the interest rate. Yes, if interest rates are probably above 6 or 7%, using a 15 times multiple makes sense. But as long-term interest rates go lower, particularly as they come below 5%, you really need to adjust your multiplier, and it can go up dramatically as rates get lower. So what does this mean in terms of the equity risk premium? Again, this is taking the differential of the earnings yield of the S&P 500 and the 30-year Treasury or the long bond. And on the top of this graph, if you're above the middle line, this tends to be a time period that's more attractive for investing in stocks. Below the line tends to be a period that's less attractive for investing in stocks. You can see today we are in a period getting less attractive. Certainly we are below the line. The equity risk premium has turned negative. It's not the lowest it's ever been. The long bond is certainly could go higher, but we have come off pretty dramatically where we were, certainly after the financial crisis, and where we were even during the COVID years. So again, something to keep an eye on as we move forward. A couple of more ratios for you to look at. Again, S&P 500 to GDP, this is the Buffett indicator. This ratio is quite high right now, the highest it's ever been, comfortably above 0.2. This ratio tends to hover around 0.1, either side of that, in more what I would call normal times, whatever that means. So again, this ratio is quite high, again, worth keeping an eye on. S&P 500 to book value, don't have as much history here, but going back to 1999 again, and using 1999 as a basis, that was pretty high valuation. You can see today that the market is even above that level. So again, something that is, at least looking back over the past 25 years, quite high relative to where it's been previously. So that leads us really to our last graph here of fair value. I've got one more graph where I'll wrap things up. But when you look at fair value, a couple things to keep in mind. Certainly as we have come off of the COVID years, as the long bond has gone up, fair value has come down pretty dramatically. And I would say fair value today is somewhere in the mid 4,000s. Again, with the stock market, the S&P today just over 6,000. You can see that fair value is quite a bit lower than it has been over the past several years. And again, the drop off is pretty dramatic. This goes back to what we talked about with interest rates. When interest rates are very, very low, that gives a lot of room for stocks to run, and that was part of the reason that the fair value estimates, shot up so high in 2020 to 2022. But things have normalized a bit today with interest rates, and again, where the market is today, we appear to be, at least measurably overvalued on the S&P 500. So what does this mean wrapping up? So this is my summary slide just showing you some of the metrics that we looked at. Again, I've got 3 color-coded indicators, green, amber, and red, showing if it's green, an investing environment that I think is compelling. If it's amber, I would call it neutral. And if it's red, I think the risk reward is relatively unbalanced and there are some downside risks. And of the 7 indicators that I like to look at, most of these that we've looked at in charts, 5 of the 7 continue to be red. 2 of them are amber, the equity risk premium, like we talked about, which is negative, but not quite as bad as we've seen it. And the nominal S&P 500 PE ratio, which again is elevated, in the high 20s, but certainly not as high as we've seen it. But everything else, whether we talk about the S&P 500 to GDP, whether we use dividends as a proxy for value, if we look at the S&P 500 to book value, or we look at the CAPE, things do look a little bit frothy out there. And you can see here in the top left, with the S&P 500 as of this recording at 6,032. When we do the calculations here using long bond and earnings estimates, I see fair value remaining still in the mid 4,000s. They've ticked up a little bit as the long bond has ticked down, but call it mid 4,000s, just a touch over 4,600. I still see the S&P 500, structurally overvalued. Call it low 30% overvalued. So, anyways, this is the end of November update. I do hope you found this helpful. I'll be back in the middle of December with an update, seeing how things are progressing. But if you like this video, please give it a thumbs up or subscribe to the channel. And thanks for watching, everyone.